Hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to our latest episode of the Market Misbehavior podcast. Today, we're sitting down with unknown market wizard Jason Shapiro. In his book, Unknown Market Wizards, Jack Schwager interviewed Jason and called him the Contrarian. Talked about how he identifies opportunities with markets overextended one way or the other, how he has found success as a CTA after many challenging trading experiences, as so many of us have early on in his career. This conversation touches on risk versus return, touches on managing the mental game of trading, talks about learning from your mistakes, keeping a trading journal, and so many great other nuggets of investment wisdom along the way. Please enjoy this conversation with Jason Shapiro. So Jason, super fantastic to sit down with you here virtually. You come highly recommended. I learned about you from the book Unknown Market Wizards, which I enjoyed, and I appreciated your discussion about mindset and approach. But a number of my viewers of the podcast have asked me to reach out to you to sit down. So thanks so much for agreeing for the interview, and good to see you.
Happy to be here. And you know, there's been quite a few of our members as well who had good things to say about you and your podcast, which is why I'm happy to be here.
Fantastic. So listen, the book Unknown Market Wizards came out a number of years ago, got updated as well, and you're featured in chapter 2 right after Peter Brandt, who's a trading legend and certainly a legend in the technical analysis community. It was such a cool profile. Tell me this, I mean, just to start out, to set the table for a discussion about humility and challenges and drawdowns and how we navigate those. I'm guessing, and I'm pretty sure from the book, I remember you having a good early wipeout story. Every good trader seems to have one of those early painful experience that kind of set the stage for them to make better decisions later. What was that early wipeout story for you? How did you come out hopefully better on the other side of that?
I mean, I had more than one wipeout.
Which one, right?
Yeah, which one? It was. I think that really, if you really want to break it down, I probably had 3.
Okay.
All of which blew me out.
Yeah.
I actually did a video, I don't know, a couple months ago on YouTube where I talk about how it set my life back 10 years.
Yeah.
I think the video was how shorting the S&P set my life back 10 years. And we laugh now, but that is in fact what it did.
Tough. Yeah.
So, my story is not really, in particular, that part of it is not really different than most people,
Yeah.
And I put it out there. It doesn't help, I don't think, but I put it out there as a warning to younger people, to earlier traders, because there's a very high probability that you're going to go through the same thing. And, this is what I say to people all the time. We're all people. We all fit underneath the normal distribution curve. And there's a very high probability that we're all going to end up doing the same thing over time, right? We all want to think that we're special. We all want to think that we're the one that's going to be able to break the rules and succeed. We all want to believe this. And as I've gotten older, you come to realize it just ain't true. We're all people. There's a level. Okay, some are a little smarter, some are a little less smart, and we can get into whether intelligence has anything to do with it anyway. But we all fit under the normal distribution curve, and 98% of us fit under the fat part of it. And so there's a good chance that your experience will be like my experience, will be like someone else's experience. And part of that experience means that when you hear me say this, you're going to say, oh, but I'm different. I don't need to listen to this guy, which is exactly what I did. You know what I mean? Like, that's the cycle, right? I put it out there anyway. Hopefully people will learn. And the ironic thing is you really can't learn it until it does happen to you. What am I going to do? I'm going to learn the lessons because Jason Shapiro told me his lesson. No, I'm going to have to learn the lessons because I learned them through my own. So maybe the message is, look, you blow out and you can say, okay, well, this guy did it too, and he ended up being okay in the end. So maybe I can keep pushing, maybe that's the lesson. I don't know. The story is really not very different. I started trading. It was a bull market. I was young. I didn't really know very much about the markets, but it was a bull market and everybody around me was talking about the markets and it seemed very exciting. They were making money. And so I got involved. and it was working because it was a bull market. Everyone's a genius in a bull market, right? We know
Yeah.
that. And so what did I do? I bought a few books. So what do you do? Okay, well, you pyramid in. Okay, yeah, pyramid in. Next thing I knew, the market was a runaway bull market, and I was pyramiding in, and so I was making a lot of money. I was a genius. I'm doing the calculations to how many months at that point it was going to take me to be, the next George Soros or whatever. I know George Soros can be a bad word for some people, but I'm talking about in terms of trading. Okay.
Yeah.
And then, of course, the bull market ended, and I gave all that money back.
Yeah.
That was the first time that happened. And then I learned in the bear market that ensued, hey, you can make money on the short side. Let's do that. And then that worked for a while. And that is the biggest drug that man, I think, has ever invented. I always compare shorting the stock market to taking heroin, which I have to this point not done. But I think that it probably gets the same chemicals going in your brain, both of those things, right? And it's incredibly addicting. Shorting the stock market is the most addicting thing. Making money, shorting the stock market is the most addicting thing I've ever been experienced.
Yeah.
Because now you're the hero, right? Everybody's losing money, and you're making money. You're the genius now, right? So I started doing that, and then of course, the bear market ended, and I gave all that back, right? But I wanted that to be. So then the third time was also shorting. In a similar situation of exactly what's gone on sort of the last 2 years from what I see a lot of people doing, which was that the market was going up, but it didn't make any sense to me.
Yeah.
Right. Because I knew macroeconomics and I knew macro and I knew all this stuff, and I knew the market didn't make any sense. So I was going to take advantage of the fact that all these people were being stupid, and I was the only smart one out there that could see this, and I was going to short it and make money and be a hero. And that didn't work very well. I was totally right, of course, and totally broke. Right? Can laugh about it now,
Right? Yeah.
They say tragedy plus time equals humor, right?
I like that. Yeah.
So, and I think this is what the cycle that pretty much everybody goes through. I don't think mine was any different. So I had to break the cycle. And to break the cycle at that point, now I'm broke, by the way. And now I'm trying to figure out what I'm going to do in my life and if trading is going to be a part of that. And I decided that if trading was going to be a part of it, I had to stop this because now I'm 10 years into it. And I had made a bunch of money and lost and made and lost and made and bought a Porsche, had to sell it, bought a house, had to sell it, all this stuff, right? But now I was older. That's all fun when you're in your 20s, not really fun, but it's the consequences are not that deep when you're in your 20s. But now I'm 30 something. I have a kid on the way. Things are getting a little bit more serious. So I have to figure out what's going on. So I got a little bit more serious about it. And I really did a lot of study. And the whole time I was doing, again, what people do when they get into this. I was reading the books about, the Market Wizard series and technical analysis books and fundamental analysis books and trading psychology books and, all the books that everybody hears about. I read them all multiple times. And I guess the one fortunate thing was I kind of listened because I was writing a diary of my trading.
Okay.
So I was able to go back and really go through that diary and figure out what was actually working as trades over time, what was working one time but not working over time, and my mind was stuck on that one time that it worked and not being honest about the fact that that type of trade did not work over time, right? And really trying to eliminate, obviously, the things that did not work over time and stick to the things that did work over time, obviously. And it was good that I had a good diary of that because I was able to go through that and do that. And slowly but surely, that helped me develop the process that I now have used for the better part of 25, 26 years.
Jason, you hit on so many great lessons learned during that sort of those formative years, and that cycle of great wins and great losses and all of that. I hope we get a lot more great insights from this conversation. If nothing else, the value of keeping a trading journal, the value of spending time to go back and reflecting on what worked and especially what didn't. I hope that's a great takeaway from this conversation already. So
Do it.
let's talk a little bit about that transition to maybe a better process, better structure. And I know in the book, it talks about the idea of risk management as being more important than prediction, right? It's about managing risk. It's about, position sizing, those sorts of decisions, as opposed to just getting the market call, right? Predicting things correctly. What does risk management mean for you? What are some of the ways that you think about risk as you approach the market on a trading day, these current days?
Let me tie it into what you also said about prediction.
Yeah.
And the last 4 years or so, I guess, I've gotten into this kind of new role in my life of trying to be a trading educator, right? So as I've done that, and I've worked with I don't know how many people, but we have I don't know how many hundreds and hundreds on our Discord. But then also I've done some private stuff, and it's really come to the forefront. A lot of these things that maybe were subconscious to me have become very, very conscious to me,
Mm.
right? And one of the things that I have really become very conscious to me is predicting where the market going to go is worth zero in the grand scheme of things. That has nothing, quite frankly, to do with making money, trading the markets over time. And I'll say it again. Predicting where the market is going to go has nothing to do with making money over time. And people are like, how is that possible?
Yeah.
If I'm going to make money, I have to predict it's going to go up and I have to get long, or I have to predict it's going to go down. I have to get short. I have this conversation not just with trading people. I have this conversation that I have political debates with or any other debates with. There has never been anybody in the history of the planet Earth who has been able to predict the future. Okay? Nostradamus is not real. Okay? So you're not going to be successful if what you're trying to do is predict the future, because you cannot predict the future. You can't do it. It's never been done, and it never will be done. Okay? What you're trying to do here, and this is where the risk comes in, is you're trying to find situations where the reward is greater than the risk you're taking, right?
Yeah.
So you're risking $1 with the potential to make $4. That's what you're trying to find. You still don't know if you're going to lose that dollar or make that $4, but that's what you have to do, right? That's 100% all this game is. It's counting cards. What we're doing here, no different in my eyes, and there may be one difference we could talk about, but in general, no different than going to the casino. Okay? It's gambling because you don't know what the outcome's going to be, right? So how are you going to make money at the casino? When you can't predict what's going to happen, it's a 50-50 bet minus the VIG, and it's usually less than a 50-50 bet. But even if it were a 50-50 bet minus the VIG, you're going to lose money over time. Mathematically certain. That's why the casinos have great art collections, right?
Yeah, sorry, you mentioned minus the VIG. For those that aren't familiar, what does that mean?
Well, the bid-ask spread.
Yeah.
And the commission, right?
Yeah. Mm-hmm.
If a thing's either going to go up or down, and you're going to make a bet, okay, you might be right 50% of the time. You and I can sit here and bet on heads or tails. I'll take heads, you take tails. I'll win 50% of the time, you'll win 50% of the time. But if we're paying 1% to the flipper, we're both going to end up with zero, and the flipper is going to end up with all of it.
Yeah, right.
The longer we go, right?
Mm-hmm.
That's all we're doing here. Believe it, okay? Or don't believe it. I don't care. But I'm telling you, from everything that I know, and I've been doing this for quite a while now. I'm 58. I started doing this when I was 21. I've worked for a lot of different prop shops with a lot of different traders. I've worked for hedge funds, big hedge funds with a lot of different money managers. I believe this with all of my heart. Okay. So how do we make money in a casino? There's essentially one way to make money in a casino other than cheating, right? You can make money in the markets on insider trading, but bad risk reward because you're going to go to jail.
Yeah.
So how do we make money in a casino? There's one way that I know of. We count cards at the blackjack table, which is why they kick you out of the casino if you count cards at the blackjack table, right? So, and even look, even if you, it's like I'm saying, even if you count cards, what are you doing? You're counting. Are there a lot of tens left in the deck? You want to get to a point where you know that there's a lot of tens left in the deck, because then there's a good chance that the guy's going to go over and you're going to win. But it still doesn't guarantee it. So you're not going to have the count in your favor and go all in on a bet, because any one bet, even with the count in your favor, is no guarantee, right? So that's where your risk management is, right? So you have to come up with a process where you're counting cards, right? We have historical data, we have back testing stuff, we have all kinds of things we can do, including keeping a journal of your trades, right? That over time can build a statistically significant history to figure out if you are in fact counting cards. Where are you getting these situations where the count is in your favor, so that if you win, you're going to make $4, and if you lose, you're going to lose $1. That's what this game is. And then once you have that, or at least you believe you have that, that seems like the hard part, and that's hard. But then the real hard part comes in, staying disciplined to that, right? Waiting to only bet when it's in your favor. The market's open 24/7. Hey, it's exciting. Buy, sell, long, short, tell my friends, FOMO, all this stuff, right? You have to be able to have the mental discipline to avoid all that stuff and just focus on. And this is only, of course, if you are serious about this. If you're doing this for fun, which a lot of people are, then forget all of this. Have fun. I don't know. A lot of people are doing it for entertainment. My job's boring, whatever. Okay, that's fine. Then do that. But if you're serious about you want to make money over time, then then you have to take it seriously. And so you have to build that discipline. And again, the only way to build that discipline is to blow that discipline and lose money blowing that discipline and writing it down, and then coming to the conclusion, I have to stop doing this so that I will now focus on this, right? So you've built this thing, you're counting cards, when the count's in your favor, and that's the only time that you can bet. That's it. Just those. If it takes a day, a week, a month, a year, I don't care. You have to sit and wait for that situation and that situation only. That's the first discipline. And then the second discipline is realizing if you have 60% in their favor, the odds, that's 40% against you. Okay. So you better know not to bet at all on one thing. As it turns out, like my win percentage, for example, is less than that. My win percentage is around 40%, a little bit less than 40%. But, my payout is 5-1. So that's okay. Right.
Yeah.
That's the other thing I think that people forget. It's not about win percentage. You could win 99% of the time. If you bet all your money on every single trade, then that 1% is going to wipe you out. So you win 99% of the time. You bet all your money on every trade, you end up with 0. So that doesn't help either, right? And almost every great trader that I've ever heard speak, I'm not talking about these sorry for my language, these people on the internet that are saying, look at my win percentage, join my thing. I have a 90% win percentage, join me and you can too. I'm not talking about those guys. I'm talking about people like, Stanley Druckenmiller, right? Paul Tudor Jones, Bruce Kovner, you name it. The most successful traders in the world. Michael Platt, these are billionaires that became billionaires via trading, right? They all will tell you that their win percentage is less than 50%, but that their payout is much higher than 3-1, 4-1, right?
Yeah.
So, this is the discipline to all of that, right? And that's really, like I say, counting the cards and figuring out how to count the cards is hard enough. Then sticking to it is that much harder, right? The mental discipline of doing that. But time will teach you to do that, because the one thing about this is, you'll lose money. And when you lose money, you'll either go broke and you'll be done, or you will come to the conclusion, I need to do something more. I need to do something differently, right?
Yeah.
So I think that's the discipline. And to be more specific about discipline of each individual trade, I look at it like this. like people are always like, where do you put your stops, or where do you take your profit, or obviously these are questions we all want to know the answer to because they're incredibly important. This is once you get to the next level. Okay, I've already built my process. Now what do? I know how I want to enter, but where do I put my stop? Where do I take my profit? And to me, the answer is always based on one question. Why did you put the trade on?
Mm.
Right? I put the trade on because, and to be honest with you, I don't care. I'm not here to tell everybody you have to trade the way I trade. Otherwise, you're never going to make money, because I don't think that that's true. There's plenty of ways to make money. I don't really like for people to trade the way that I trade, because you're not me. I don't want to trade the way you trade because I'm not you. So psychologically, you're not going to have success trading the way I trade, just like I'm not going to have success trading the way you trade. The way I trade fits me, fits my personality, fits the way that I think, fits the way that I approach life in general. You maybe don't do that, so that's silly. But however you trade, right? Why did I get into this trade? X. So where do I get out of this trade? Well, when X no longer exists, it's to me the answer, right?
Mm.
Or when X is proven wrong, I get
Yeah.
out. That's where I stop out, right? I stop out when X is proven wrong. I get out when X no longer exists.
Yeah.
It's really that simple. Why'd you get in? That'll tell you when you should stop or when you should get out. My system is based on kind of turn picking, right?
Yep.
I find, for whatever reason, things get very extreme at turns, and I'm pretty good at smelling out the psychology of extremes. So I trade the turn. So let's say I'm picking a bottom in something. Okay, so here it is. I think that was the bottom. Okay, I get in. If it goes through the low, well, then I didn't get the bottom by definition, did I? Right?
Mm.
So I stop out there. I thought it was the bottom. The market has proven to me it's not the bottom. So I
Yeah.
stop out. I can always try it again some other time, but I stop out. It's not the bottom by definition. It's a new low. So how is it the bottom? It's not. Right?
Yeah.
So that's where I stop. That's what you should stop. Pick something else. I'm a breakout trader. I'm a momentum trader. Okay. I'm buying this because it's breaking out. Okay. Well, where does that breakout a failed breakout? And that's got to be where your stop is.
Mm.
And trust me, 80% of the time you're going to wish that you didn't stop there. You're going to get stopped out, and then it's going to go your way, right? And you're going to be pissed. But it's those other 20% of the time that's going to keep you in business.
Yeah. Yeah.
And if you're not in business anymore, none of it matters. If you have no money left in your trading account, none of it matters, because you're out of the game. You have to stay in the game. And I know that the stops, I'm making up the 80-20 thing. That's usually pretty typical with everything,
Yeah.
right? That 20% will save you and keep you in the game. So that's how, like, from a risk management point of view, how I stop out of things, or how everybody, I think, should stop out of things, no matter how you're trading. And then how I get out. Okay, the things that are telling me that this is euphoric, people are, let's say, massively bearish here, way over bearish here, so I'm getting long. Well, what was I using to measure that people are way overly bearish here? And when that goes away, now the trade worked. I bought it. I thought that people were massively bearish here. I get long. The market goes up, it goes in my favor. Now the bearishness is going away. Obviously, the market's going up, so the bearishness is going away. Well, then my same readings will now tell me, well, people are not bearish anymore. Okay, well, then I'm out. Does that mean that the market's going to top right there and start going down? No. It means that I captured what it is I was trying to capture. They're going from massively bearish. This is a very general term, very general idea of what I do, but from massively bearish to not bearish anymore.
Yeah.
That's where I play. Does that not mean that they can go from not bearish anymore to massively bullish? They could do that, and that's where trend followers make their money.
Yeah.
But I'm not a trend follower. I'm
Yeah.
a picker. So no matter how you're doing it, let's say you're a macro person, I think that the stock market is going to crash because, pick a reason, because everybody's got 100 of them these days, but whatever, the deficit is too high or something, okay, great. But if the market makes a new high, then you're wrong. So you stop doing it.
Yeah. And isn't the challenge, Jason, I think for so many is just, I always tell people, because a lot of my followers are technical analysis oriented. They're swing
Okay.
traders or position traders or something.
Okay.
when the chart tells you it's no longer a good trade. You just have to listen to it. And I find so many times people just ignore the clear evidence that whatever trade they were putting on is not working, right? Justin Mamus famously said, when you buy a stock and it doesn't do what you think it's supposed to, sell it. Just sell it,
Yes.
get out. It wasn't the move.
And I take it the other way as well. Now,
Okay.
the technical analysis people probably will do this already
Mhm.
if they're doing technical analysis correctly, I think. And I'm
Mhm.
not a technician, but if you like a trade idea, again, for whatever reason, macro, micro, technical, fundamental, I don't care what the reason is. That doesn't mean you have to put it on right now. Put it on when the market is telling you you're right. You know, the
Yeah.
market is everything here, right?
Yeah.
Because the market is what we are trading, right? There's no, I'm going to short the market because I think GDP is going to shrink because my brother owns a shoe store and it's down, his business is down 60% this Christmas. Okay. That might be a good signal that GDP is going to shrink. But that doesn't mean that the market's going down. Maybe GDP shrinks and they cut rates and the market goes up. We're trading the market. We're not trading a contract on GDP growth, right? So
Yeah.
you have to let the market agree with you first. Let the market. I always tell people, I don't care why you get in a trade. I really don't, right? Not that it matters whether I care or not, but you shouldn't care. It doesn't matter why you get in. The market has to agree with you. Then you get in. Just like you say, when the market doesn't agree with you,
Yeah.
that's when you get out.
But and isn't it funny, Jason? I feel like and there's often a disconnect between this idea we think of what should happen and what actually is happening, but we try to trade it anyways. And I would say the other side of that is a lot of times you find traders trying to trade out of a bad run, right? You're struggling, so you try to trade out of it. You're trading when an opportunity doesn't present itself. So what do you do, or what words of wisdom would you have for people who struggle with that? How do you stay patient? Wait for the good pitches is kind of the trite way of thinking about it. But how do you do that in real terms?
Give it time, because if you don't do it, you're going to lose money. I
Yeah.
mean, I'm not even
Yeah.
trying to be funny. It's the truth. Give it
Yeah.
time. Either listen to what David's saying, listen to what I'm saying, listen to what 100 people who have been successful are saying, because they all say this. Okay. Either listen to that and be a grown up and be in the, I would argue, less than 1% that can do that,
Yeah.
or just give it time and learn the lesson for yourself, which is what I had to do because I'm a stubborn, and in particular then, stubborn, immature kid that knew everything. I didn't have to listen to anything anybody said because I was taking over the world. The markets are a great place to learn those lessons, right?
That's true.
And listen, it becomes very difficult. The market, if you become successful at trading the market and successful at understanding these concepts that we are talking about, I'll be
Mm.
frank with you, it makes the world outside very difficult
Mm.
because the world outside doesn't really work that way. The world outside tends
Yeah.
to work in a lot of ways in popularity. You know, it's not about whether the movie was good or bad. If you're at a party talking about a movie and you think the movie sucks and everybody else think the movie's great, well, then you're wrong because it's a popularity thing. You can't prove that the movie sucked, right? You're in a
Mm.
room and you're talking politics and whatever for whatever room you're in, and it's either one room or the other this day, this day and age. But if you're in the wrong room, you're going to lose. It doesn't matter whether you're right or whatever. You're losing the argument because you're voted out.
Yeah.
That's not how it works in the market. In the market,
Yeah.
there is an answer. It is either going to go up or down, and it's very, very measurable, right? So you have to get out of that type of thinking. I want to be right. We all want to be right. That's what the world is, right? Everybody wants to be right. You have to get that out of your mind.
Mm. Yep. Yep.
Because that's what leads to the rest of the things that you're talking about. I'm not getting out of this trade at a loss because I don't want to be wrong, or I'm going to now double up because I know I'm right, and it's just a matter. I'm just wrong temporarily. All these things are based on the psychology of I want to be right.
Yeah.
And you have to somehow, like I say, you either have to stop doing that, or you will learn in time that you have to stop doing that. That's up to the individual person. And like I say, 99% of the people are going to have to learn the hard
Yeah.
way, so to speak. I know I did.
Yeah.
One of the last time I blew out was, I don't know, in the late 90s. The stock market was going up. And I was shorting, and Greenspan came out and said that, there was irrational exuberance. And I was like, there's only two people in the world that are smart enough to know this, me and Alan Greenspan. And the market closed up that day.
Yeah, right. Yeah.
So it's like, okay, so me and Alan Greenspan are right, but I'm broke. Alan Greenspan still gets to hold his job, okay, because he's not trading. All right, so he can be wrong. I can't, as a trader, I can't. So that's it. That's it. You have to accept being wrong, and it's okay. What I like to say now is, be wrong, make money.
Yeah.
Which one do you want to do? Right?
Yeah.
I think that Donald Trump is whatever, the worst guy that ever lived, and I think his policies are horrible and this and that. But you know what? The stock market's going up, so I'm going to get long. Okay. So I'm wrong, but I'm making money.
Yeah.
So who cares? In trading, I'm not talking about in life or your morality or whatever. I'm talking about trading. Trading, there's only one way to measure, and that's P&L. That's it, right?
Yeah.
So be wrong, make money. Be right, make money. Be wrong, make money. It doesn't matter which one. Just make money. Right?
Make money.
And the answer to that is to let the market tell you. There's always a bullish and bearish side to all of it. Yeah. You can make the bearish side all the time. You can make the bullish side all the time. But the market's going to tell you.
I want to talk, Jason, about one particular tool that a number of people asked me to ask you about, the commitment of traders data, right? The COT data. In your report, the crowded market report, I know it's a contrarian approach, right? Thinking of where, we're sort of overextended on one side or the other. Can you talk a little bit about how you use at a high level, how you use commitment of traders data, what that tells you, and how that fits into some of these themes we've talked about in terms of identifying opportunities and recognizing, when you're right, defining that with appropriate outcomes?
I pick turns.
Okay.
I'll try to say this as quickly as possible. You have to understand this is my entire life thesis, so it might take a little bit more than 5 seconds.
All right, here we go.
But the market is a discounting mechanism.
Sure.
Page 1 of any finance textbook, right?
Yeah.
What does that mean? In the price is everything that everybody knows already, so you're not going to have an advantage unless you have insider information. Okay. So what's the discounting mechanism? Most people will look at this price, i.e., this thing has gone up a lot, therefore it's discounted in the good news. I don't agree with that. I don't think that price is the discounting mechanism. I think participation is the discounting mechanism. It's not, this thing has gone up a lot, therefore it's discounted in the good news. It's everybody in the world is long this thing already, therefore it's discounted in the good news. So that's a positioning thing. So how do I know if everybody in the world is long this thing already? Well, one way to try and capture that is the commitments of traders data, which is given out by the futures exchanges and tells you where people are positioned in the futures market. So I can take that data, I can turn it into an oscillator, and I can say, this is the longest these speculators have ever been this market in the last 3 years. Therefore, they're very long. So I am looking to go the other way. It doesn't mean I'm going to go the other way. This stuff does not work every single time.
Yeah.
First of all, every time it's crowded like that does not mean that the market turns. And second of all, every time the market turns, it doesn't have to be because it's crowded like that. Okay. I'm not playing all things for all people. All I care about is, does this data give me enough times where it works, where when I'm right, I make $5, and where I'm wrong, I lose $1.
Yeah.
And like I say, 37% of the time it works. So that's how I use commitments as a trader. I'm trying to measure, are people super long or super short? And it can work on so many levels that I can give you examples of not the way I do it is, okay, everybody's short. I'm looking to get long, and then I get a trigger when the market agrees with me, then I will get long. Everybody's super long. I'm looking to get short. When the market gives me a sign that it agrees with me, I'm getting short. That's how I do it. But there's a million ways to do it. Silver recently, okay, has shown no signs that people have gotten crowded long on the commemorative trader.
Wow.
None. Whereas if you were looking at price, you would have been like, this is ridiculous. It's overdone. It's overbought. It's over this. It's over that. Everybody's bullish. Everybody's this. Everybody's that. The positioning has said, no, they're not even close. So if you were a trend follower or a breakout trader, whatever you want to call it, this would have helped you to stay in to silver trade.
Yeah.
This entire time, which is clearly what you want to have been, right? Same thing with the stock trade for the last few years. So that's a way that I don't use it because I'm not a trend follower. But for me, what that helps me do is it saves me, because if I was just what I used to be when I was younger and I didn't use this data, just some wise ass guy trying to be contrarian, I would have been shorting silver. It's gone up so much, and I would have subconsciously heard only the people that were super bullish, and therefore thought that the contrarian trade was to go the other way. And I would have gotten run over. Right. So if it's done nothing else, it has saved me from doing that. Not losing money is just as important over time as making money, right? So there's an example where it's worked. It hasn't gotten a trade for me, but it's helped me from losing money, right? So there's an example with that, and that's what the commemorative traders does.
So one final question, Jason. This has been absolutely awesome, by the way, and I appreciate it. So if silver doesn't seem particularly crowded here, which again, I'm super surprised, which is why I know in my own process, I undervalue the importance of commitment of traders, and talking to someone like you and anyone else who uses it. Larry Williams comes to mind. I always jot down, I need to have a better routine of evaluating commitment of traders data, because obviously there seems to be something there. What is a crowded trade that you're seeing right now? Is there a place where you're seeing a concentration that makes you feel, unlike silver, there may be some sort of crowded environment based on that kind of data?
Probably stuff that most people aren't interested in, but the most crowded trade we have here is soybean oil. Got super crowded short a few weeks ago, and you can see it's from, I don't know, 48 to 51 in 2 weeks, right? Once it turned, once the reversal day, which there was, it's basically gone straight up since then. There's an argument here that on a relative basis, the Dow has become crowded long, relative to the other indices, which I think, and I always have to be careful because I always can get biased just like anybody else, but I think that also matches with the fact that what we're hearing people say every day, I hear it, which is, what is 2026 going to be? 2026 is going to be the broadening trade, right? You have to get into the companies that are going to be the beneficiaries of AI now, not just the pick and shovel AI companies, but the beneficiary companies, meaning the industrials, the car companies, right? Meaning the banks, right? Because they have all these people that they're going to be able to eliminate. And, we hear that every day. Well, those are Dow companies, right? And it's ironic to me because they're saying that now, but meanwhile, this has already happened. Look what GM's done over the last 3 months. Look what Citibank, these companies have outperformed the AI companies in the last 2-3 months. And now everybody's jumping on the idea, right? So it's interesting to me that we're seeing Dow relative to something like the NASDAQ as much more crowded on the long side. So like short Dow relative to NASDAQ, that kind of trade is what it's talking about as well.
Very interesting. Jason, this has been awesome. I mean, you clearly, I know reading Unknown Market Wizards, I was really excited to be able to chat with you. You clearly have a lot to offer in terms of your life experiences, your trading experiences, but a great way of approaching the markets, I think, mentally as well. So on behalf of the viewers of Market Misbehavior, thank you so much for coming on the show. I hope this is the first of multiple conversations we can have, but for now, I'll say thanks so much for giving us some time today.
Great. Thanks for having me.
tell you what, that conversation with Jason Shapiro, I feel like we just scratched the surface of so many wonderful things to dig into. I do hope we can get Jason back on the show here later this year to dig a little bit more into some of these themes. But, you know, we talked about the idea of crowded trades, and in his work, in his report called the Crowded Market Report, Jason looks for these opportunities. And I was very interested to hear that silver was not a crowded trade according to his work. I love that comment about the Dow versus the NASDAQ and some of the commitment of traders data he's observing here in mid-January of 2026. Besides current market environment sort of discussion, I also really appreciate Jason's thoughts on keeping a trading journal. If you'll note, he mentioned the value of keeping a trading journal, the value of taking time, making time to go back and reflect on good decisions and even ones that were not so successful, and how you can grow as a trader by really digging into some of your own experiences over time. You talked about the mindset and just how often you're wrong. I feel like so many traders are chasing the wrong benchmark. As he mentioned, you see on social media, you see in ads, people talking about their hit rate, their batting average. I'm right 80, 90% of the time, or whatever ridiculous number that is. That's not the game, right? Your goal is not to be right more than you're wrong. Your goal is to make money. And if you can make money being wrong more than you're right, but just staying right and admitting when you're wrong, seems like a pretty good strategy in my book. And I think Jason's success certainly speaks to that. Great discussion about, in his perspective, recognizing when the market is validating your thesis, recognizing when the market is not validating your thesis. Now, Jason would not call himself a technical analyst. I don't have the ability to, award honorary technical analysis degrees or designations, but if I could, I'd probably send one Jason's way, because I think he talks like a technician very well in terms of the value of finding swings, the value of focusing on what the market is telling back to us. I have always learned, in my experience as a technical analyst, price is the great arbiter of reality. That is the great, most effective way of really measuring how the market is moving relative to your expectations. And when the market's not doing what you think it should, when you have a position and the market moves against it, admit you're wrong and move on. And that alone can save you so much in your trading, in your investing. So if you take nothing else away, I hope you remember those lessons. Thanks again to Jason Shapiro, editor of the Crowded Market Report and featured interviewee in Unknown Market Wizards by Jack Schwager. Really enjoyed the conversation. We'll hope to have you back again later this year. As a reminder, we're always looking for great guests for the Market Misbehavior podcast. We've got some really great ones lined up here for the month of January, but we're always looking for more. If you have any suggestions, please drop them in our comments section anywhere you're listening to the podcast. We'd appreciate it a great deal. Also, if you want to learn more about some of the technical analysis tools we can use to identify extended markets, to identify contrarian opportunities on a swing trading time frame, to identify trends and longer-term opportunities if you're a position trader, our Market Misbehavior Premium memberships can do a great deal in helping you improve your own ability to identify rewards, potentially, and also to manage risk. 3 great benefits of the premium membership. First off, all of our virtual courses, you'll have access to those on demand at your own pace. You'll learn about what's happening between your ears. That's called behavioral finance, and the tools you can use to better understand the market action. That's called technical analysis. Number 2, you will have all of our member-only reports, like our monthly chart review, our weekly flight plan, and a lot of great, random comments as well during the course of the week. Finally, you'll have full and immediate access to our member community, where you can learn from other like-minded investors. You can ask questions at any point. I'm in there every day answering questions from our premium members, and we'd love to have you join that small and thriving community. You can get more info at marketmisbehavior.com/premium. Don't forget to use the code PODCAST when you check out for 30% off your first 12 months on any plan. That'll do it for today. Thanks so much for watching the Market Misbehavior podcast. And as always, we're here to remind you that it's always a good time to own good charts. Take care, folks.